Starting here, socials. All right, get started. Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Morning, Kirk. Afternoon, morning, wherever you are, wherever you may be. I guess.
Happy Friday. Happy Friday. It's every week I'm so thankful the week's over because I can't wait for the weekend to find out what's going to happen in Iran.
Are we going to finish it up or are we going to run away? I don't know what's going to happen here.
Yeah, to me, there's this pattern that's been emerging, and if you study Trump like I do, because you kind of have to nowadays, there's no point in reading financial reports. You just look at his truths and see what he says.
That's why they call it Truth Social, Kirk.
Yeah, I mean that's a lot of the funny memes going around. It's like I don't pay attention anymore. I just see what he says. It's like I think that's what the markets have devolved into. But in reality, if you look at the last 4 weeks, and Trump said this would take 4 weeks, and it's 4 weeks today, I think, and it's still going on. But I guess my initial thought was it would last 3 weeks because Trump likes to peg it in the long end and then beat his own expectations. But it's still going on, as most of you might have imagined. And so what I find interesting is there's been a pattern for the last 3 weeks, which is Monday and Tuesday, there's some news over the weekend. Monday and Tuesday, the markets rise. And then, either Wednesday or Thursday, the markets start to decline for the week. So it's like, 1% to 2% up, and then it's basically 2% to 3% down. And so we've been slowly declining. The markets have been slowly declining over the last few weeks. Thursdays and Fridays are always bad. Today is no exception. And then Monday and Tuesday, everything's rosy again. And then we just repeat the cycle over and over again. And it doesn't really matter what the news is, because the news, I think people are slowly learning that they can't trust what is being told to them. I don't, I mentioned this last week. My son asked me, like, what's going on in Iran? I'm like, I don't know. We have really no idea. We have suspicions, and we have enough people where you could say, all right, enough people are saying this, but I don't know if it's true. What I do know is that Trump's patterns are typically the same. So he starts with, let's bomb the crap out of them. And then he says, all right, let's give them a way out, which is, oh, they're negotiating. We settled on finding some time. You got a week and we'll figure it out. And then at the end of the week, if they're not moving forward, then he starts bombing them again. Well, he extended the deadline until April 6th, which is another week and a half. And then there's been some rumors about it's going to be a month to work this out. I don't really know what's true. I just know that he said it got till April 6th. So it sounds like they're not bombing, or at least the U.S. isn't bombing. I don't know about Israel, but the U.S. isn't bombing till then, and they're going to try to work something out. You hear a lot of stuff. I'm really not sure what's true. I know that I believe none of what I see and half of what I hear. I think that's don't believe your lying eyes. So I don't really know what's true, but here's what I do know. You can look at the markets to figure out what's going on. So if you see some news, watch the markets. Do the markets react or not? If they didn't react, then the news is BS. That's how I look at it. The markets collectively know a lot more than you and I. And if you take nothing else away from this episode today, take this away. Is that if you want to know if news is important or not, just watch the market's reaction to it. If news comes out and the markets go up, it's good news. If the markets go down, it's bad news. It doesn't matter what you think is true. It doesn't matter what your favorite prognosticator says is true, like me or Doug. It doesn't matter what we say is true. If something happens, like if Trump comes out and says the problem's been solved and the markets go down, it means it hasn't been solved, or the solution's terrible, right? But you don't know. All you know is the market's reaction. The markets tend to react, not necessarily immediately, but like maybe over a few days. If Trump comes out and says, all right, we solved it, problem's over, never gonna have a problem in the Middle East again, and the markets don't react, then the markets don't believe it. So you want to be careful about what you read, and the best indicator of what's true is how the market's reacting to it. Now, the reaction may not be what you expect. So for instance, you would think that the markets are going down, and the war is a bad thing, and yet both stocks and bonds are declining. Why are bonds declining? Right? Because the yields are going up. The expectation is that if we have high oil prices, it leads to higher inflation. And higher inflation means higher interest rates. They're correlated, right? And I'm not going to get into the causative because it depends, but generally they're correlative. Higher inflation equals higher interest rates. The market tends to correlate with inflation. So if you start to see interest rates dropping, it's probably because inflation is dropping. If interest rates are going up, it means that inflation is going up. Now, I think we can all agree that in the short term, we're going to have inflation. You know, I've seen it in the gas pump. My gas prices have not quite doubled, but gone up substantially, almost doubled since the war started. And I hesitate to fill my heating tank, my oil tank, because I don't want to pay full price when the war might be over in a week or two. So there's a lot of that going on. And so inflation is definitely going to be higher because transportation costs are going up. Everything's going up. My propane company decided to fill my tank on the day of the first spike of oil prices, which I kindly yelled at them, and they negotiated a lower price because they didn't certainly buy it at that higher price, and I didn't ask for them to fill it. So anyway, you might see a lot of that stuff going on. But what I think you're going to start to see is you're going to start to see inflation come up a little bit, but it's going to be followed. Let's say the war ends tomorrow, hypothetically. The war ends tomorrow. You're still going to see inflation for a little while because you've had a month of this. But after a little bit, oil prices are probably going to go through the floor and be really low, and you're going to start to see inflation drop rapidly. Now, a lot of that depends on the length of the war. The longer this goes on, the bigger the problem we're going to have, because the supply chain has stopped with energy prices and with chemicals and all the stuff coming out of the Strait of Hormuz. It's virtually stopped. And so, you know, there's been a problem, and all the prices are going up because people are just trying to get access to the commodity. Now, when that opens up, it's going to plummet. But for the moment, it's causing real problems. It's causing real problems with the growing season because a lot of that relies on basically natural gas, LNG. You know, you've got fertilizer, you've got all this stuff. And so the growing season is going to be really interesting. A lot of people speculate that corn prices are going to be pretty high this year because people can plant wheat. It's usually like a soybean, corn. Actually, it's soybean and corn, I believe, right? Is it anyway? But there's going to be a corn spike this year, I suspect, based on the fact that they're not going to be making as much of it because it relies a lot on the fertilizer, which they don't have enough of. So it's easier just to use crops that don't rely on as much fertilizer. So there's a lot of that stuff going on. And if you look at the markets and see what's performed well, energy companies perform well. Some of the ag companies, some, not all of them. Fertilizer companies are doing well. Chemical companies. There's a lot of companies that are doing well, like interspaced in the economy, but most are not. And actually, a lot of the changes in trend are being hidden by this war. One of the changes in trend is technology. Technology is becoming a little bit more out of favor, a large part because of AI, and people are starting to put two and two together, and that equals zero when it comes to AI's impact on software. So software companies are really becoming a little problematic right now, and that's why you're seeing companies like Microsoft and all these other software companies like Adobe are just getting taken to the cleaners. I mean, Adobe's hit all-time, or 52-week lows. Microsoft's down like 26, 27%. Microsoft's one of the Mag 7. It should be, one of the better companies in the world, according to most people. But, it's down 26%. Is it a buying opportunity, or is it just the beginning? I don't know. I guess it depends on what the conclusion is of what AI does to software. So there's this big roll going on in software where a lot of them are rolling over. It's going to potentially impact a lot of these tech companies. So personally, this is not advice. I would not own a lot of tech, if any, right now. I would just steer clear. I think until the coast is clear and we know exactly how AI is going to impact tech, I would be a little suspicious, I guess, at this point of tech in general. It doesn't mean they're not good companies. Doesn't mean they're not going to make money. Doesn't mean that they're not going to grow. I'm just saying that I would just be cautious and don't just throw all your chips on the table and be like, oh, look at the cheap buy. I'm just going to put it all in. No, there were times to do that. Now is not one of them. The war is not the reason why those companies are down. They were dropping before the war. So just be cautious is my point. It's not advice. I'm going to show a chart crime. I'm going to hand it over to Doug and we'll flip flop here. So here we go. So there's I saw this fun chart and this has been flopping around a little bit. So I wanted to share it. And here we go. So I pulled the chart crime guys. So unfortunately I couldn't pull the chart. But so basically what a lot of people will do is they'll look back in history and they'll overlay history with today. And if you look back from 66 to 82, that's the blue line. It shows what happened. So basically in the early 70s, we had a spike and then it came down in the late 70s and then spiked again into the early 80s and then came down. And that was it. So that was a huge spike in inflation, the CPI. Now, if you look at 2013 to 2026, you're looking at this, you're like, wow, look, it's so similar. It's almost the same. Can imagine that there's going to be a huge spike in inflation right now. Could be, or maybe not. I would look back at history and say, what happened to cause these spikes? Well, it wasn't just random chance. There were actual events that happened. There was an oil embargo, which is coincidence. Wow, oil and oil, that they're similar, so it must be the same. No, it's not the same. They were like, you could only get gas like once a week on even and odd days, depending on your license plate. And they had all these things that they determined when you could get gas. And you had to wait in line for like hours just to get gas. I mean, it was kind of crazy. So when you think about then compared to now, things are similar but different. Do I think we're going to see, according to this, a 10 to was that 14? It was up to 12, 14. So are we going to see like 10% inflation again? I doubt that. We had 10% or close to, we had 9.5 or 9 and change during COVID when the whole world was shut down. Are we going to see that again? Probably not. I would say the chances, I would, if you want to bet me, I will take you that bet because I think the chances are really low that we're going to see inflation like that. I don't care how much money we're going to print. I don't think we will, but even if we do, I don't think that's going to cause it. So what I think is going to happen is actually the exact opposite. I think what we're seeing is a temporary spike, which I do agree is going to happen while this war goes on. The longer it goes on, the more problematic it's going to be. However, when the war ends or when the conflict stops and the Strait of Hormuz is flowing, I think we're going to see prices go a lot lower. We were seeing inflation dropping prior to the war. It was dropping actually quite a bit. If you look at Trueflation, we have Oliver Rust on every once in a while. He and his brother do Trueflation, which a lot of people use now. And they're showing inflation is actually a lot lower than the CPI. So I think I would suggest that inflation is lower than people think. And that, yes, it's going to bounce here, but I don't think it'll be long-lived. Now, if this war drags out 6 to 9 months, I have the right to change my mind. 6 to 9 months, if it drags out that long, then I think we'll see. And if we have the Strait of Hormuz frozen for that long, yes, we are absolutely going to have inflation. But I don't think that's going to happen. I don't think the world's going to let that happen. If the world has to nuke Iran to get that to stop, they will do that because that is the lifeblood of the world is flowing through there. So, however, I do think there'll be some long-term solutions after this because I don't think people want this to happen again. So anyway, I thought this is a good chart crime. It just shows how people analyze things. They say, well, look at all the similarities. It must be going up next. No, that's not how to look at it. I would look at that as, oh, isn't that interesting that this lines up so well? But I don't think this is going to happen in the same way for many reasons. But the main reason is because we don't have the same events going on. And certainly back then things happened slower. Now things happen quicker. So I think if anything, we're going to see lower. We'll see a bounce here and then we'll probably see a lot lower. So that's my quote unquote prediction. But that's the thesis we're working on anyway. So what are your thoughts, Doug?
Yeah, I think the one of the big, if we were going to take any time period and try to do a, your dogs have a few things to say about this. Should we interview them, Kirk, next week? um, I think that there's some, certainly some correlation between the stagflation era of the 70s and today, that could lead to similar outcomes. But I agree, there's a completely separate set of variables that are involved overall. First of all, I think that we've talked about this, that one of the issues that happened, with Burns was a lack of conviction on where to go with the Fed, and that is certainly something that we saw a little bit of that flip flopping with Powell, but not nearly to the same level. We said I think he's trying to be more vocal. Sorry. The other issue is that we had two things going on in that period. Is we had, as you mentioned, high inflation, which did peak at 14%. We also had a sustained 14-year window where the average returns were more in the lines of about 0.5% return per year, which was absolutely terrible. But right now, we've seen inflation spike. We did see it come back down. Who knows if it's going to go back up and follow the pattern that's being projected that is going to be the reality. But at the same time, even though we've had a minor relative pullback in the markets, this is nothing. We're not even close to the level of pullback that that we average on any given year. It's not unusual for the S&P to have up to a 14% pullback on any given year, and I think the latest is we're down around 10. So on top of that, yeah, we've had a major pullback on commodity pricing, especially gold and silver, but still, depending on when you got in, you could be up 100%. I mean, we are not at that level of just these tepid returns. And I don't think there's anything that can indicate that we're going to fall into that anytime soon. Is it possible? Absolutely. No prediction here. But I think, we watch that more closely. I think, to transition to what I'm seeing, especially in the last week, is I think we've moved into what I would call an adjustment phase. The market stops reacting and they just start repricing. We're no longer in shock anymore, although you could argue how much the shock really had on the markets. I mean, at the beginning of the war, they barely moved at all. Now they've kind of systemically, eroded a little bit, but we never really had any blasting, effect on the markets that, of any real out of the norm black swan significance. The Iran war is not new anymore. It's now arguably priced in. Oil volatility is still elevated, less panic, more positioning. And, I think the people have moved from emotion to evaluation. And that's typical for a third week situation. Oil, hard to say what's going to happen. And I agree. If we do have a tendency, and we're already beginning to feel this a little bit with some of the recent announcements that the administration made about allowing some oil to come through and through the straits. From our standpoint, is to me, it's evidence the administration is watching the impact of commodities. You mentioned fertilizer. That's definitely a major concern going into our growing season. And ultimately, if that happens, if oil prices stay high, if fertilizer prices go up, and that ends up raising the price of food, that's not going to be good for the midterms. We talked about this last time. They are very, very. The optics on the midterms are extreme. And I think that you're already seeing signs that we're trying to get out of it. If Iran agrees to this, we will let them. This is all, it's talk, it's negotiation standpoint. Who knows to the degree that we would actually just, sit there and say, okay, congratulations, Iran. You have met our expectations, and we're now going to let you go back to day to day. I mean, to me, I think that's a little bit dangerous, the level of that we've gone in to Iran at this point in time, to just pull back. But that's kind of the American way. Once things get uncomfortable, we tend to back down. So if we stay in this, the story is not necessarily how high oil goes, but it could be how low it won't go if this is sustained. If all of a sudden we get, figure out a way to get out of this, oil prices could plummet. Because we control and produce the most oil on the planet right now. We're not at the same level. Although global oil prices are global, we're not at the same level of reliance that we were in the 70s. I mean, if we had to, we could certainly commandeer all of our oil and help to keep it keep the supply high here. But it has led to inflation expectations quietly creeping back. Supply risk remains unresolved, and if we stay in this, then oil just prices become sticky. Rate cut expectations. They just had a Fed meeting, and they elected to keep rates the same. So again, I love the predictions, Kirk, that we always see. Oh, we expect that they're going to have X number of cuts in the upcoming year, and I think you and I both roll our eyes. Instead, those predictions are like what's, and they're subject to change. By the way, I do want to call you out. If you know anything about the way you're supposed to be in social media, you're not allowed to change your mind, right? Once you make a prediction, Kirk, that you're going to be held accountable to that prediction into the future, right? Forever. That's kind of the way we treat it, which is not the way it should be. Prediction, I love when you have some of the biggest names like, in sports, Colin Cowherd, or other people where, they get held like, well, you said this. Like, yeah, but new information came out. And that's what's going to happen here. So rate cuts now, the expectations have quietly faded. They voted not to do any rate cuts. We had expected more. Earlier narrative was that they were coming. Now, delayed or fewer cuts, but I think the market, although not probably a surprise to you or me, realizing inflation risk isn't gone. And so they went, the market's gone from when cuts to maybe not yet. Overall, the market breadth is still weak. Under the surface issue is that we're still seeing big names mostly holding up. Broader market participation weak. Small caps are still lagging. The scoreboard looks fine, but the bench is thin. I think that, one of the things that we are seeing, and where I will push back a little bit, depending on what kind of a trader you are. If you are a fundamental trader, I would hold off on doing much right this second. If you're a technicals trader, there's definitely areas in the market, at least on a short term, we are approaching, 2 standards of deviation. And some areas have even exceeded that, especially in technology. And, depending on whether or not the technology you're in has a nice dividend worth holding, there might be a positioning if the computerized trading runs things as we firmly believe they have a lot of influence these days, where you might see a small spike coming off of some of those deviations and those 50 and 200-day moving averages. So there might be some, if you're saying, well, I should get out now, it may, from a technical standpoint, not be a time to get out, and there may be a small bump, but that doesn't correlate to fundamentals. Those are still continuing to erode and will if we stay in this. And now that, speaking of erosion, talked about this a little bit last week, housing, the freeze is the story. We're still not crashing, but we're not recovering. Mortgage rates, they've been stuck in this, 6 to 6.3, although I saw earlier this week that some reports they were back over 7. That's going to make transactions continue to be sluggish. You're seeing inventory rising slowly everywhere. Prices are softening slightly, and significantly in certain markets. And if we go into the spring with a frozen housing market and we have an erosion of fundamentals in other areas, that could create a situation where there might be an increased level of desperation for liquidity. Now, this is one of the risks you run into with housing. Everybody likes to talk about their net worth and how housing's evolved, and there's people that argue you should always look at net worth of housing. You have to look at liquid net worth differently than total net worth, because push comes to shove, liquidity is going to be where you're going to be able to function in an economy. Illiquid is not. Just saw this morning that one of them, I don't think it's Wells Fargo, so don't hold me accountable to this. It might be Morgan Stanley, Goldman. One of them just announced they're no longer going to allow for the next 3 to 4 years liquidation events on some of their commercial portfolios. And that, of course, is a whole different beast that, when we talked about, buildings that used to sell for 200 are now selling for like less than 50. That is, million. That is absolutely a problem that is nowhere near resolving. We've just got a lot of brick and mortar out there that's relatively worthless. Yeah, that's a value to buy, but can you hold it 20 years and can you fix it up and maintain it in a way that's going to, allow you to come back? Real estate's expensive. And so buying it but buying a $300 million building at 20 million, sure, heck of a value, but there's a tremendous level of cost that is that maintain just holding it, much less updating it, keeping it, etc. And so it's going to take a lot of capital to sit on that and see that opportunity arise where they can turn it into a liquidation event. So huge risk there. We are seeing a little bit of a shift on the consumer going from discretionary to essential spending. Credit usage continues to rise. Saving buffers are declining. They're not collapsing, but they are pulling back. On the banking side of things, private credit tightening, continuing. There's a slow burn there. So I think the biggest thing, liquidity, is a huge variable. Global fracturing is becoming investable. It's not just political anymore. It's financial, supply chain shifts, energy, currency. Geopolitics is no longer background noise. It is an asset class driver, and it's finally coming in to where, it's not just do anything, tech's going to run, AI, huge risk there. But overall, Kirk, I think, narrative fatigue is starting to set in. People are, if they're listening to this, they're not there yet, but in many areas, people are tuning out. The markets aren't. Headlines are less shocking. Investors are becoming desensitized. The risks are still building underneath. So the headlines feel quieter, but the risks aren't. Where I would say positioning, again, don't make any big moves, but still working energy, commodities, select defensives, cash flow businesses. Again, are you getting paid to hold that risk? More interesting areas are oversold quality assets. Again, that's a fundamental, that's a technical play with a fundamental element. And select cyclicals, if we don't go into a recession, could be okay. And there are tactical opportunities from volatility. They're not going to be long-term plays. But where I would be very cautious is leverage, over-leveraged, high-yield debt, private lending, over-leveraged companies, rate-sensitive sectors, narrow leadership trades. I mean, this is a trader's market, and it's a planner's market. It is not a passive autopilot market. And I do not believe that most people out there that that have management and portfolios understand how to manage it in this market. They have lived on the glory of passive investing for the last 15 years. And as we get into more of these variables, this is going to be a time where, we're going to see who that washes out.
Yeah, no, I agree. I think some of the things to take away from this are, in this kind of a market, you've got, let's try to dissect them. There are bull markets, and bull markets are generally where they increase over time, which we've pretty much had a bull market since 2020, although 22, I think it was the year that they raised interest rates. That was a bad year. But generally, if you look at the market since pretty much 2008, they've pretty much gone up. And yeah, there have been pullbacks, there have been bad years, but in general, it's been a bull market since 2008. So we're going on 18 years, right, of a bull market, which is extremely long. And what people don't realize, especially newer investors, because they don't have the experience of a full cycle, is that in a full cycle, things are not always the same. And this is something I see the most, so I wanted to kind of share it. One of them is this. In a bull market, the thing you do is you buy the dip. You're rewarded for buying the dip. Market pulls back 10%, buy the dip. Pulls back 20, buy more. That's great in a bull market, okay? And you get rewarded because in a bull market, it's going up and then it declines and it goes up again more and then declines. That's normal. That's how markets operate in a bull market. Now, in a bear market, it's the reverse. And there's some new rules too. It's not just that, but there's some new rules. But in general, in a bear market, it works the opposite. It goes down and then it comes up and then down some more and then up a little bit and down some more. It's the exact opposite of a bull market, right? Now, do you think you should buy the dip in a bear market? No. That only works in a bull market, because in a bull market, I don't use the word guarantee. You're assured that it's going to keep going higher if you buy the dip. So even if you miss it, if it goes down 10 and let's say you buy it down 10, it goes down 20, that'll come back. It'll be fine, right? And this is what most investors say, and this is what Warren Buffett says. Well, if I buy at a good price, then I can just wait forever because it'll work itself out. And Warren Buffett's correct if his time frame is infinity. But when you have to retire at some point, or you have to use the money at some point, you don't have an infinite number of years to wait. The best thing to do is say, all right, if we're in a bull market, I can buy the dip. If I miss a little bit, it's okay because it's still going to keep going higher. In a bear market, if you buy the dip, it just keeps going. So you have to invert your rules for a bull market in a bear market. In a bear market, what you do is you do the opposite. So instead of buying on the dip, you sell on what they call the rip. So if the market goes down and then pops up, on that pop up, that's where you short it. And it goes down, then it pops up. At the pop up, you short it. That's a bear market. Now, I'm not suggesting at all you short it. I'm just telling you how the markets operate. So you want to invert all the rules, right? Buying the dip, selling the rip in a bear market, right? In a bull market, you can buy and hold. Buy and hold is rewarded. Even if you buy it incorrectly, as long as it's going up, you're going to make money. Maybe you don't make as much money as everybody else, but you're going to make money because pretty much everything's going up. Now, that's not what happens in a bear market. What happens in a bear market is you've got this whole generation of people who are accustomed to buy and holding. And they're like, well, I'll just buy and hold. It'll come back. And it keeps going down and lower and lower and lower. And sometimes it never comes back, or never meaning for a long time. I think it was Cisco that had a high on in 99, and I think it maybe recently exceeded that high, only recently, like 25 some years later. There were a bunch of companies like that. I mean, Microsoft, I think, bottomed out in 2014 before it started to go higher. That's 14 late, and that's a good, it's a solid company, one of the better ones. And 14 years later, before it started to pick up after the 80% sell-off in the NASDAQ, my point is yes, eventually it goes higher, but do you really want to wait 15 years to get your money back? No, I don't. So in a bull market, you're rewarded for buying and holding and just hanging out, right? And just you can index, it'll be fine, it'll go higher, I don't have to worry about it. In a bear market, that's not what happens. In a bear market, like 2000 to 2013, the stock market went nowhere for 13 years. It went down, it went up, it went down, it went up. But if you take those 2 points, it never went higher than January of 2000, and I think it was July in 2013, I think it was. It never went higher than that. So you basically were losing money for that whole period of time, even though it went up and down. So did buying and holding reward you? No. Did it reward you in the 70s? Absolutely not. So what you have to be aware of in a bear market is that it's not going to operate the same way. The rules are different. In a bear market, you're not rewarded for buying and holding, right? You're rewarded for taking some small profits and getting out. You should not be making big bets. You should not be buying and hoping and saying, oh, it'll come back. Making it come back could take a long, long time. So you're better off having a short trigger and selling quickly if you're wrong than to try to hold and wait till it comes back. If you were 100% in cash right now, that wouldn't be a terrible thing, right? Now most people would be like, oh my God, that's shocking. You're in cash. yes, I'm not suggesting you'd be in cash for the next 100 years, because I know someone's going to say, well, inflation's going to kill my cash. No, it's not. Inflation will kill your cash over 100 years. Is it going to happen in a year? No. If you're making 3.5% in your cash and inflation's 4%, so you lose 0.5%, are you going to care? Well, if the market's going down 15%, I'm not going to care, right? So you have to put things in perspective. And I'm not making advice here. I'm just suggesting that you need to change your frame of how you look at investing. You can't just look at investing as a binary, well, Wall Street says it's this way, it's a rule of thumb, I should do it this way. Yes, everything in Wall Street is what we call a half-truth. A half-truth is something that sounds true, it's academically true on the surface, except for one thing. And that one thing pretty much reshuffles the whole deck, okay? So yeah, buy and hold works, except for bear markets, right? Buy the dip works, except for bear markets, right? Cash is trash, as Ray Dalio says, except for bear markets. So all these things that you quote unquote know to be true in your bones because everyone says it and everyone believes it and Warren Buffett says it, so it must be true. Yes, they're half-truths. Virtually everything on Wall Street is a half-truth. I would love for somebody to give me an example of something that's not. Virtually everything's a half-truth on Wall Street.
Why is Buffett still sitting on so much cash, Kurt?
Yeah, I know. He's got the largest cash position, although he's not managing it anymore. But, you know, Berkshire's the biggest cash position they've had ever, I think. But point being, I mean, Berkshire's basically a money market fund at this point. But if you look at all of the quote unquote rules that you think you know, the good rules have caveats for bear markets. Because right now, as Doug suggested, you should be, and I'm not suggesting anybody do this, you should understand technical investing. And if you have skills there, you should focus there and less on the fundamentals. Fundamentals aren't going to reward you because here's the reason fundamentals won't reward you. Now let's take three Mag 7 stocks, okay? Let's take Google, let's take Microsoft, and let's take Apple, okay? They're similar enough companies. You can interchange them. Yes, they're different, but in the grand scheme of things, we all see them as the same, right? It's a big company, it deals with technology, and they make lots of money, okay? Now let's take those three companies, okay? One is kind of holding up, so to speak. One of them is actually, the other one's kind of holding up, so to speak. And one of them is not doing very well at all. Do the fundamentals indicate which one is not doing well? What do you think, Doug? Are the fundamentals the reason? And I'll tell you that Apple is kind of more or less holding its own. Google's kind of more or less holding its own. And Microsoft's down like 27%. Do fundamentals indicate which one is which?
Not at all.
No, absolutely not. The one that's doing the worst in
the best
context
fundamental
is Apple, because Apple's not growing. And when I mean worse, I don't mean it's doing poorly. I mean it's just the revenues and profits aren't growing. Microsoft is doing fine, but the stock's down 27%. The fundamentals would dictate what the hell is it going on? We should just buy the dip. And if you look at Google, Google's holding up as well. So I won't talk about Google. But if you look at those three, you're like, well, Apple's should be performing the worst because it's not growing. But Apple's holding up, and Google's holding up, and Microsoft's not. Why? It has nothing to do with fundamentals. It has to do with the fact that everyone's worried that software is going to get eaten alive by AI. That's what everybody's worried about. That's why the stock's down. It's not the fundamentals. So do fundamentals help you?
Apple's a hardware company that is shiny and looks, and sorry to interrupt, but it's funny. My son is a scout, and he did the coin collecting merit badge last weekend, and they had like a mock auction. And my son started driving up prices, and I go, "What are you doing? You don't want to buy that." He goes, "Dad, I know I'm driving up prices because all the little kids are they're going to spend all their money on these shiny objects that actually are worthless." And that's exactly what they did. These kids were buying, they had a $200 budget. They're spending $150 for basically like tokens from a fair. And he goes, "Because it's shiny and gold looking, Dad." That's Apple.
Yep. It's smart, Doug. You taught him well. That's what we call that's like when you have an election, you have a bullet vote. You vote for three people, just vote for one. That's the bullet vote. Yeah, smart dadding right there. So anyway, so when you think about the context of what you're doing, fundamentals aren't going to help you in a bear market. They might over a long period of time. If the bear market was like 10 years, that they would eventually help you. But over short periods of time, they don't help you. Technicals will help you, because if you know how to trade or invest technically, then you know, like, if you're investing for this thing and it goes against you, you just get out. Like, I was wrong. Like, I thought prior to this that bonds would be a good idea, and turns out they're not, because high oil prices lead to inflation. Like, what the hell's going on? Well, it turns out that the market was right and I was wrong. So I got out quickly and I was like, oh, I was wrong, I'm out. That's how you have to think in a bear market. You can't get tied to positions. You have to be in and out quick. You have to have your exit, which is, if you have a loss, it's a small loss. If you have a win, take your money and go home. It's like at the casino, right? You don't just win and you put it all in the next hand, right? You have to manage the money in your pocket that you're going to gamble with. Go with $100 and you win. You're like, wow, I got 200. Put it all on red. No, that's not what you do. So what you want to do is you want to focus on, how do I, how do I manage my risk and manage my trades? Now, here's another piece, and I'll hand it back to Doug. Here's another piece to take away from this. When you're investing in a bull market, you can be a little bit piggish, okay? Let's say you're investing in the Mag 7. They've gone up for 5 years in a row. They've beaten everybody else. Everyone else is zero, and they're going up like, I think NVIDIA was up like 100% one year. It's crazy. By the way, I don't know if anyone noticed Walmart was up 100% like a few years ago, and no one's mentioned it. I don't think anybody noticed. Sometimes these things happen. Weird, though. So if you see stuff like that, you can be a bit of a pig sometimes. Precious metals did really well last year, and people were rewarded, or people were being pigs and were like, yeah, I'm just going to invest more because it's going up. In a market like this, you're not rewarded for being a pig. You actually get hurt for being a pig. So if your normal position is, let's say, 5% into a company, and you're investing 5% of your $100, let's say you have $100, you're putting $5 into, or 5% into a company. Instead of doing 5, maybe do 2.5, or maybe 1 or 2. Right? You want to at least half your position sizing what you used to do. Because regardless of how good you think you are, I can tell you that even if you're winning in a bear market, you're probably going to end up losing. Most people do. That's what bear markets do. They cause everybody to lose their chips. And here's the secret that people don't realize. They say, well, it's a zero-sum game. If I'm losing, somebody else is winning. No, not necessarily. Because in a market where there's no leverage, you would be correct. We don't live in that world. There's a ton of leverage in the market. So when you see these days where everything's red, except for maybe the US dollar, what that means is that it's called degrossing or deleveraging. So when you sell your leverage, it doesn't mean you're buying something else, because you're selling something you didn't have to begin with. So if you have $100 and you buy $200 worth of stuff, you have $100 of leverage. It's imaginary. It's not equity you have. It's debt to somebody else. So when you pay that loan back by selling the position, that debt disappears. You still have your equity, and if you made money, now you have more money. But if you lose money, you have less. So the degrossing or the deleveraging that's going on in the system doesn't mean the money's going anywhere. It's just disappearing because it's leverage. So the leverage is disappearing. Now, as the markets go up, it will add and it will cause the markets to go up. But right now, people are deleveraging. The smart ones deleveraged weeks ago. But owning less right now is smart. You don't want to be fully invested in markets like this. You want to be cautious. You want to reduce your position sizing. If your max size is of 5%, go down to 2, 2.5, or 1%, go lower. And just start small. And if you're doing things well and things are working, then you can increase it. But I would not be taking big risks in this market. I certainly have been taking a lot fewer risks in this market. I'm more strategic. I'm more tactical. I'm looking at things at quick wins when I see them, and if I don't see them, I do nothing. I'm just happy sitting around doing nothing right now. And that would be perfectly fine until we have direction. Right now, our direction's down, and I'm not shorting the market. I don't short the market. I am not smart enough to do that. Very few people are. I don't know if anybody is. Even Chanos, who's the world's greatest shorter, according to everyone. Even he says, like, I'm right 20% of the time or something like that. It's not an easy game. When the markets go down, you could be a Yahoo and say, I shorted the market all the way down. Great. And you could just easily lose it. I'm not that smart. And I know I'm not that smart. I don't know who is. But what I do know is I'm not taking chances, because think of it this way. If I have $100 and Doug has $100, Doug's invested in the S&P 500 and I'm invested in cash. And the S&P 500 goes down 50%. Doug's 100 is now worth 50. I still have $100. Now, if I go and buy twice as much, if I buy 2 of those shares, Doug has 1, now I buy 2 because they're at $50 and I have 100, I just doubled my money because I didn't lose it. So in relation to everything else, everything's going down. My cash isn't. My cash is now more valuable. So when people say cash is trash, inflation's going to kill it, they don't understand math. Because the math is that if everything else loses value and you don't, your cash is more valuable. That's, some people would call that deflation. There's a lot of terms, asset deflation. But I would think about that. Cash is not a bad thing to have. Keep the cash, because let's say the market keeps going. Let's say it gets worse. Let's say it gets a lot worse. And you're in the market. You're going to feel stupid. But if you have cash, I'm not saying 100% or nothing. You 20% cash, 10%, I don't care. Do whatever you want. But if you have some cash and the market goes down 50, well, now you can buy stuff real cheap. You can sit on it and make a whole lot of money. But you can't do that if you're fully invested. So the reason for cash, and I always get this question, especially from new clients, is why do we have cash in our portfolio? This is the reason. It's what we call optionality, the optionality of cash, because you have the option to invest it at any point in time you want. And you also have liquidity when no one else does, which means, you know, it's kind of like the movie The Big Short, where they shorted all this money and they made lots of money, but they need somebody to buy it back. And when everyone's crying in 2008 because everyone lost money, and you can go in like Warren Buffett did. Warren Buffett came in 2008, 2009, said, I'll buy you, I'll buy you, I'll buy you. And he got special Warren Buffett preferred shares in Goldman Sachs, in Harley Davidson, in Bank of America. There were a ton of them he got. And he basically just went in and said, I'm going to give you a pile of cash. You're going to give me warrants. I think he got warrants. Like, he got preferred stock at like 12% or some crazy number plus warrants. So he got the shares. He was getting paid like 12, 15% a year on his cash. And he got warrants in the stock, which he could sell at a later date. It was genius negotiation on his part. Brilliant. You can only do that when you have cash. Now, I'm not big enough to make those kind of deals, but if you have cash, you can get access to stuff dirt cheap. So Doug, final, wrap it up here. Final thoughts from you.
My goodness, I can't believe we're up on the hour already.
I know. Time flies when you're having fun.
It is. So I wanted to, so I think, you know, you mentioned a couple of important things. I definitely wouldn't short the market. Never short the market. If you short, so if you buy something long and it goes out of business, your risk is finite. If you buy it at $80 a share and it goes to zero, you lose $80 a share. If you short something, you're effectively borrowing the stock with a promise to pay it back once you exercise to liquidate it. So you're borrowing, then you will buy the stock, it's a little technical, and pay it at whatever price it's at that time. The idea is, I see it at 80, I am going to borrow, and then when it drops to say 20, I'm going to take that $60 profit off that loss. The problem is that it works reverse of a typical purchase, in that you are now you want the price to go down so you can buy it back at a cheaper amount. And the issue is that it can actually go up into perpetuity. An $80 stock could become, you know, where say a Netflix or something is today, where you're $1,000 a share. And at the time you try to finally liquidate that short, you could actually owe on $1,000 per share or wherever it went to. And that is just, it's absolutely can be disastrous. So what are some of the better ways to do it? Well, this is truly an options market, an options traders market. An option traders market does very well when you have volatility. Now, I would say over, you know, Kirk, you could probably agree with me. There's opportunities there. The last couple of weeks of just simple erosion, not a necessarily an option trader's market unless you really know what you're looking for. It's not big swings and erosion, a straight line one direction or the other is not great for options. But when you get a lot of bouncing around unpredictability, this can be a way to, play the market if you know what you're doing, to or use someone, hey Kirk, maybe like you, who understands how to play these options, and some of your team that can watch for these things and buy things that are that have good values because there's a price to that option based on how popular that option is or how close to like paying out it is. Again, I'm not getting into the technicals. I'll let you worry about that later, Kirk. But the point is this is something where it can give you a way of betting against that stock, but yet your real cost, especially if you already own the stock, is purely just the price of putting that option out there and buying that contract. So is there a cost and a risk? Sure. But worst case, you just let let it expire. The other thing to understand is that there is secular and cyclical bear markets, guys, and bull markets, by the way. Let's not just stick to one. And what that means, and I did put a picture there, whereas a cyclical bear market or bull market is a phase that lasts a few months to several years, representing ups and downs. A secular cycle is a trend that tends to last 10 to 20 years and can be predominantly one or the other, bullish or bearish. So we've been in a secular bull market for an extended period of time. We might be entering into a secular bear market. Now, a secular bear market is going to be similar to what we dealt with in, say, 1968 to 1982, or what we ran into in 2000 all the way to 2013. That is an area in which the markets are predominantly going to be going in the negative direction. Now, a secular bull market, obviously, no matter what you did, you could be, trading wise, you could be the biggest idiot on the planet and you'd look like a genius because the markets overall just went up by the dip, right? Now, a secular bear market's going to eat you alive on that over time. And so that is not a buy and hold market in a secular bear market. That doesn't mean you have to be out of the markets the entire time. Cyclical cycles are the mini trends within it, and I've got I don't know if you're looking at that from a vision standpoint, you really want to be looking at it as something where, Kirk, you're still kind of showing top 10 winners or losers. I don't know if you want to share maybe one of the latest pictures I put in there of the market, but ultimately you can take a look at an image where overall the trend line is one way or the other, but inside of it you might get this period where it dips shortly. That could actually be a great trader's opportunity, right? So if you know what you're doing and you're much more active in that cycle, you can actually watch for opportunities that will take you, capturing mini gains or avoiding mini losses within the bigger trend. And that can be, an excellent opportunity for trading options, or just an excellent opportunity for someone who is a very good active trader. I know there's a lot of and that takes a lot of oversight and a lot of watching. So you can't just sit there, set it, and forget it. I like what you said, Kirk, about sitting in cash and inflation. The thing is that if you are in a position where you have cash to work with, right, in a down market, you can actually make up for lost time through getting back into a secular type of a bull market opportunity. This is where you can take advantage of potentially leverage. And there are some people out there that do a great job of, look, we're going to wait on cash until trend lines turn the other direction. And then we're going to use leverage to extend or give ourselves extra buying power, where you're going to be able to, instead of buying, one share per, X dollars you have, you can buy 3 to 5 shares of X dollars you have by expending that through leverage. Again, there is risk to that too. This is not a long-term buy and hold strategy, but it's a way of kind of making up and really putting octane in the tank at times in which something has extremely pulled back. And you do that for a short period of time, it can help to buy you out of those. But again, these are risks. that I wouldn't jump into if you don't absolutely know what you're doing. And this is where getting help is critical. Understanding options is critical. Putting boundaries around those lanes. Those are going to be the things that are going to help winners be winners from losers in markets and situations like that. And if you don't understand it or you don't have the time to look into it, my advice to you is is to just maybe free up some cash or sit on cash that you have and then wait to kind of buy in on a normal one-to-one non-leverage basis when things turn around, and then ride that through these secular markets. The one thing I did want to touch base before I actually jump here is, I've talked about this the last couple of weeks. And we talked about this a year ago. They just came out with a new report, which it really gets published monthly, but I just saw this. U.S. banks are currently facing unrealized losses of $306 billion. As bad as that sounds, I would say that that's actually a positive trend, that with lowering interest rates over the last couple of years, we've actually seen that after this great, large unrealized losses they were sitting on happened after they raised interest rates, we've actually seen those unrealized losses from 2022 come back from around 450 billion down to only 306. So that's been a positive trend. The downside of that is that if we all of a sudden see a turn in the markets or a turn in interest rates like we have recently, we could start to see those unrealized losses go down again. What does that mean? Well, it means absolutely nothing if we don't actually have a situation that causes the banks to have to sell those assets prematurely. We'll wait till next week on this because I got a great picture to kind of explain what unrealized losses really mean. But again, as long as there's no real run on banks and people don't need excess liquidity coming out of them, then the banks don't have to sell anything, and it's a big nothing burger. But if we all of a sudden get in a situation where people need extensive liquidations from banks, that's where the banks are at risk unless the government steps up again, like they did a couple years ago with something like the bank term lending program. I've talked about that ad nauseum, but again, this was basically the government ejecting liquidity to these banks when they needed it. It happened around the time of the Silicon Valley Bank collapse. So I'm just going to wrap up here. Here's the shift that's happening. The market, summary, the markets aren't reacting to headlines anymore. They're adjusting to reality. Energy costs have reset higher. Rate cuts have been pushed out. Housing is still stalled. Consumers becoming more selective. Liquidity slowly tightening beneath the surface. So like we've been saying, it's not a bad thing to have liquidity right now because it could be harder and harder to get it when you need it. This is what a transitional phase looks like. Not a crash, not a boom, a recalibration. Might be temporary, might be long-term, but this is where most investors make their biggest mistakes. Because when things aren't clearly up or clearly down, people start guessing. And they chase short-term moves. They buy the dip in a bear market. They overreact to noise. They lose sight of structure. And at Mergent Advisors, we focus on eliminating that guesswork. We help families map out the entire financial picture. It includes income, assets, liabilities, tax exposure, college planning and costs, retirement income, etc., so that you can see exactly where your plan is and how it holds up as conditions change. Because environments like this, clarity is everything. If you were to lose your job tomorrow, as we have seen some people do, some people that we know with some very high incomes that are, as much as they're making, they've all of a sudden found out that, unfortunately, they also have a lot of obligations, and that can be scary if the plan wasn't already in place to know what they have and where to go. Clarity tells you where the income's coming from, where you're exposed to risk, what's protected, and what needs attention before you ever come up upon it. That's how you build confidence. It's not from predicting markets. It's actually from understanding your own micro structure of your household. And this is where the difference shows up. Most people, they react to change. A disciplined investor is going to prepare for it. You're going to find that if you really feel that you want to understand how your plan holds up in this environment, this is a good time to visit mergentadvisors.net, MERGENT, MERGENT, mergentadvisors.net. Start the conversation because markets will always adjust. The question is, are you positioned to adjust with them? look forward to seeing you next time, Kurt.
Yeah, thanks, Doug. And just as we wrap it up here, I want everyone to know, I mean, if you're looking at the markets right now, the things to be careful of are technology and financials. The things that are doing well is not much, basically cash and energy sector. Not much is doing well. If you kind of look at the screen and see what everything's doing and you see everything's down, even though the indexes aren't down a lot, when a lot of stuff's down, you could say, all right, maybe that's a sign, because this isn't one day, this is weeks. Now, if the war ends, we'll see what happens then. But for now, until it does, I think even if it does, I think you can look at technology is probably still going to struggle. Financials are still going to struggle. And the financials are large part because of private credit, but it's also because there's a flattening yield curve. The banks make a lot of money when you have a steep yield curve, and that's what everyone thought was going to happen. Oh, it's going to keep getting steeper. That's not what's happening. It's been flattening, and flattening equals financials don't make money, because they make money off the spread, off the short and the long term, and as it's flattening. So if the short is down here and the long term's up here, banks make lots of money. When it's flat, there's no way for them to make a lot of money. So banks don't tend to do well in this environment. So the more it flattens, and our suspicion is that it's going to continue to flatten, even if rates go up, it can still be flat. They're two independent things. There's the slope of the yield curve, and then there's the rate. So, if a curve is steep, so the short end is low and the long end is high. So like, let's say the treasury bills are like 3.5, and let's say the 30-year is 5. Just, it's not, but let's say for example, that's a big spread, and the banks can make lots of money. But you can flatten that one of two ways. Either the long end comes down, or the short end comes up, or both, right? It doesn't have to be one or the other. So even though people are worried about, oh my God, there's gonna be inflation, the short end's gonna go up. Yeah, but that's gonna flatten the yield curve. The long end doesn't go up. So what you've got is a short-term problem, which means you're gonna have a flatter yield curve, which means banks make less. I suspect that's going to continue even after the war. So I'd be a little cautious of the financials. Plus, you've got the private credit exposure, which is unknown at the moment. The solution is unknown at the moment. It's struggling quite a bit, and financial sector has a lot of exposure. So do the insurance companies, by the way. So be careful, insurance companies. So you want to be real careful about that. Technology's got problems of its own, independent of the war. It's, you've got AI that's people are starting to wake up to. So I would be careful of those two areas. If we have deflation after the war, which I suspect there will, then you want to be careful of commodities. Now, independently, some things like corn might do well because of the fertilizer, but in general, I'd be a little cautious about that. And also bonds should start to do well. Because if inflation's really low, interest rates should start to come down, and that means bonds should do well. So you want to be real careful in this environment. Don't be a pig. You wait for a trend to emerge before you be a pig. If the trend takes 2 years to emerge, then you can sit in your hands for 2 years. Believe me, inflation's not your biggest problem. Your biggest problem is you, because you're going to want to do something with your money. Why am I not doing something with my money is a question I get a lot. I want to do something with it. Like, okay, can you go to the casino and watch? Like, why do you have to participate? Sometimes the best, I love this line from the movie War Games with Matthew Broderick, where at the end it said, so the best strategy is not to play. Yes, sometimes the best strategy is not to play. And now might be one of those times. So I just use this as a cautionary tale for your portfolio. It's not advice, but I would take this into consideration, because if this continues to go on for a while, then I think a lot of people are going to struggle quite a bit. So, like I said, it's not advice, but I would just be a little bit cautious. So that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth; we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shouting and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.